to listen today. And as we just heard, please know that this is being recorded. We'll get started in just a minute here. But first, as your hosts, we want to briefly introduce ourselves. I am Michelle Brock, the Executive Director with the Catholic Foundation in the Archdiocese of Dubuque, headquartered in Cedar Rapids. I'm joined by Sue McEntee, my co-host, Executive Director at the Catholic Foundation of Southwest Iowa, headquartered in Des Moines. As you can see, we have some general information about our foundations on the screen there and encourage you to reach out to us with any questions. Our Catholic foundations are community foundations, separate but collaborative with our diocese. We help meet the needs of those that our Catholic community serves through sustainable funding by connecting donors and organizations. We work with these donors and organizations to help meet both spiritual and basic human needs in a manner that reflects Catholic values.
Thanks, Michelle. We'll get started here with a webinar. Know that this webinar has been approved for legal continuing education, and we're happy to send that out to attorneys at the end of the webinar. If you have any questions during the webinar, please use the Q&A port. I'll monitor that for John and let him know what questions we have. And just a little bit about John. Not only is he a great presenter with lots of years of experience in this industry, but I have been blessed and very proud to have worked side by side with him during my professional career. And I know that what he talks about today, you will be very excited to hear him and to just learn a little bit more about charitable gift annuities and donor advised funds. I'm going to stop sharing for a moment here. And John should come on now.
Okay, I understand that I'm on. We're having difficulty hearing each other, but I'd ask if any participants that can hear me, would you raise your hand so we can make certain that you're hearing me? Oh, I'm not seeing any hands raised. All right. Well, I think we'll move forward on that basis. And I'm going to share my screen here. There we are. Okay. All right, you can hear. Now, if I can get this to go on the program that I want, that would be nice. There we go. There we go. So, hi. What's everybody doing? We're going to be okay, I think. So, I'm John Syverson. I'm here in West Des Moines. And some of you may know me. I've been around for a long time, just getting old. I've had over 45 years experience in the financial services world. I actually started in 1972. And it was interesting, 1984, 12 years later, I took a trip out to Boston and took signed up at a conference for a, breakout session. Breakout session was called Charitable Estate Planning. Well, I've been doing estate planning for 12 years. I knew everything there was to know about estate planning. And I was quite charitable. I knew I'd never have enough money to give away as much as I'd like, but maybe I learned something. Well, in that 1 hour, I learned what I didn't know. There's a lot I didn't know, and a lot of it had to do with what I was never taught in all my training and all my advanced designations. That in 1969, Congress passed the Tax Reform Act of 69, which created a whole nother a drawer in my toolbox that I never knew about. It created charitable remainder trust, charitable lead trust, bargain sales, pooled income funds, charitable life estates, all those wonderful tools that since that time I've been able to use in my wealth management practice here in Des Moines, which now I'm officially retiring from. So I'm joining the ranks of the retirees. I'm on fixed income. We'll take a collection a little bit later. Oh no, that's for later. I'm getting paid by the diocese to do this, so I'll survive another week. But in that time in 1984, what I learned about all these charitable planning tools, I then started incorporating them into our financial planning business and adding philanthropy as the sixth component of a comprehensive financial plan on top of the other five that the Certified Financial Planner Board of Standards had created. And so I've been asked to share just a couple of those devices today that are quite useful. from a total financial planning perspective, but all these are just tools that have to fit into a total comprehensive plan. So I believe strongly in doing the work collaboratively with other advisors, working with accountants and attorneys, insurance people, and so on to help the donor client accomplish all their objectives. And usually these charitable tools are just a piece. They fit into a broader puzzle. So that's where I'm coming from. I do have a chartered philanthropy designation. I was one of the first in the nation to get that. In fact, I helped them write the curriculum at the American College way back then. They have improved a lot on it since that time. I probably never passed today. But so I've had an interest in philanthropy and continue to do so. And one of the things that I was asked to speak about is a very, very useful tool called the Donor Advice Fund. Many of you probably have had experience with that. And if you haven't, you probably should look into it. I personally have had a donor advice fund since 1991 and I've enjoyed using it personally. It's really defined as an account owned by a sponsoring public charity. Public's the key word, where the donor or someone appointed by the donor can recommend grants or even the investment of the funds. So it's just an account that you have some you have some granting capabilities of. It's they're really lower administrative costs than a private foundation. You can make grants out of there to any public charity or 501c3 charity. And since some of the recent tax acts, it's harder and harder for clients to itemize tax deductions. So DAFs, we call them, are perfect for bunching gifts. I'll give you an example of that. So you can itemize maybe every other year, every third year. So they're just a wonderful, wonderful tax planning tool to help people with their philanthropy. What I like about it is I've disconnected the tax deductible contribution from my ultimate distribution of charity. They don't have to happen in the same year. So when did DAFs really start? Well, some would say back in 1931, where the New York Community Trust set up something like a DAF. But then in 1969, the tax law I talked about had the law enacted that defined what private foundations were and weren't. And that's where then community funds created DAFs that are classified as public charities, where the private foundation is a private charity. And so we'll talk about some of those differences as we go along. Then in 1993, good old Fidelity, they kicked the ball and kicked the field goal and started the charitable gift fund. It was the first major big commercial charitable gift fund. And they're still at it. They're one of the largest, if not the largest charity in the country today. And then back in the 90s, though, we started learning about abuses. People were trying to use these DAFs inappropriately, which happens to any good tax planning tool, unfortunately. And then finally, in 2006, Congress enacted some legislation that will actually define DAFs and give you penalties if you're not using them correctly. So the term donor advice fund simply means an account, fund or account, which number one is separately identified by reference to contributions of a donor or donors. Okay, it's set aside with your name on it. You can have a sub fund at a public foundation with your name on it, where you're the donor. And then, but the actual assets are owned and controlled by the sponsoring organization, the 501c3 that's holding this fund. In this case, it'd be the Diocese of Dubuque or the Diocese Foundation of Southwest Iowa. And that, by the way, those foundations, as I understand, are separate and apart from the diocese itself. Okay. And number three, with respect to which a donor has or reasonably expects to have advisory privileges. You don't own the account, but it feels like it, with respect to the distribution of and or some cases the investment of the amounts held in the fund or account by reason of the donor's status as a donor. Thus, it's a donor advised fund. And so, again, when you make a contribution to a donor advised fund, you made a contribution to charity, but you haven't made the ultimate distribution yet necessarily, because that fund is just a holding tank that's going to be able to be directed by you to make distributions out of that tank to public charities when you decide to do that. There are certain types of grants that you cannot make to out of a donor advised fund. You can't make a grant to your next door neighbor whose refrigerator just broke. They are not a 501c3 public charity. You can't make a grant for a non-charitable purpose. And you can't make a grant to something other than a public charity where the charity failed to exercise expenditure responsibility. It's a technical term. So you have to basically make a grant to a legitimate charity that's doing charitable work, that's recognized by the government, and to whom, if you made a direct contribution, it would be tax deductible. So the positives of a private foundation. Let's compare this now to a private foundation. And by the way, I've been at this a long time. I've been doing this type of work since 1984. I have yet to set up a private foundation for a client. I've tore some down and turned them into donor advised funds. But what's the big attraction of a private foundation? It's control. You basically have your own board of directors. You can have your family serve. You can hire your family, give them a salary within reason, and so on. And you can make grants and you can control the investments. But the negatives from a planner's perspective are you're going to see that you get a lower income tax deduction for gifts of real estate and closely held stock. And then there are some additional taxes and excise taxes that are involved with that have to be paid out of a private foundation. And normally of higher administrative costs, it has a separate tax return because it is a separate taxpayer entity. And even though the word private is in the name of a private foundation, they're anything but private. You have to file a simplified Form 990 annually and report to the government, which is public information as to how much was in your private foundation and who you made grants to. It's anything but private, whereas a donor advice fund, you can elect to keep your distributions private or even anonymous. So I hope that gives you kind of a comparison on private versus what I call a public foundation, otherwise called a donor advice fund. Okay, now we're not there we go. Now, so with a donor advice fund, there are some negatives. You have loss of legal control over the investments. You cannot tell and demand that the charity invests those funds in a certain way. You can recommend, and they may or may not listen to you. Some charities are set up to allow for a donor to call the investment shots, and in other charities, they're not. I believe in the case of these two foundations in Iowa, they have strict rules about how the money is invested, and the donor does not have control over that. They may be able to select within a couple of types of funds, but they can't tell the foundation where to invest the money, etc. You have to cope with policies of administrating the charity. Again, when you use a donor advice fund, that host charity, they set up the rules. In this case, it would be the two foundations that are hosting this event today. And so there are certain excise taxes on excess business holdings. That doesn't happen very often, but if you contribute some business interest to like in LLC units, C Corp stock, etc., and hold it in a donor advice fund, you can hold it for 5 years. And if you don't have a plan for distributing that, you can get some heavy excise business holding excise taxes. It doesn't happen very often. I've done it a couple of times, and basically we had to kind of unwind it about 10 years down the line because we ran out of excuses to hold it there that long. On the positive side, lower administrative costs. You don't have to worry about filing a tax return for this foundation because it's a public charity. The public charity files one tax return for the whole foundation. You have public charity status for donations, and I'm going to compare the two tax statuses of private versus public in here in a little bit. And you have access to staff if it's a community foundation that's hosting it, or in your case, Catholic foundations are hosting this. You have access to your staff that can maybe help you make decisions on grant making. You're looking to support a particular Catholic entity that helps children or orphans. Well, if you don't know where they are, go to Sue and Michelle. They will tell you where they are, and they can help you make those grants. And kind of a big positive, in my opinion, is the anonymity for grants. In fact, you can make a grant to a nonprofit and not be exposed as to where the grant came from. You won't even get a thank you note. They won't even know you did it. It's just an anonymous grant from a nameless donor advice fund. Why would someone want to do that? Well, a couple of reasons. Maybe you want to make a major gift to a particular nonprofit. Maybe it's your own parish to kickstart a big campaign, but you don't want anyone to know about it. You want to kind of do your giving in the closet, like the scripture would say. Want to be real low key. Number one. And number two is if you also don't want to get on everybody's mailing list and get all kinds of solicitations thereafter for making a major gift. So you can make your grants anonymous, or you can make them known. So here's a nice chart that I found years ago comparing a donor advised fund to a private foundation. So a donor advised fund, of course, qualifies as a public charity itself, and you make distributions to public charities. A private foundation, you have many organizations, individuals, as long as grant is made for a charitable purpose. So they're kind of the same, but not quite. Investment, you can decide how the contribution is invested within the parameters offered by your donor advised fund host. And in a private foundation, you have total control on how the contribution is invested, because you basically own this foundation, and you got in charge of the board of directors and so on. Some people think that's an advantage. I'm not sure how big of an advantage it would be, but that would be up to you. Here's the big difference on the tax deductibility. From my perspective, it's like, why would you ever use a private foundation when you're doing tax planning compared to a donor advised fund, which is under the auspices of a public foundation? Well, when you make a contribution to a donor advised fund, currently, if you're contributing cash, you can contribute and deduct in a given year up to 60% of your adjusted gross income. If you contribute more than 60% of your adjusted gross income, you have a 5-year carry forward to use up that deduction. If you're giving appreciated stock, real estate, any kind of appreciated asset, the most you can deduct in a given year is 30% of your adjusted gross income, and then it carries over for the next 5 years as well. What we found is, and usually what happens is you're at a point where you're either selling an appreciated piece of real estate, or you're selling appreciated business interest, and so your AGI goes way up that year in the year that you sold it. And so you sold it last April, and now you're visiting with your accountant, your tax attorney. Here it is, November 16th. Well, what are we going to do about that big capital gain that we incurred there when we sold our business or sold a piece of real estate? Well, we can make a major contribution to your donor advised fund and deduct that against your income, but you're still limited to 30% of your AGI. However, your AGI could really be boosted this year when you just sold a $10 million corporation. So all of a sudden you've got a very large AGI. So the 30% limitation is still reasonable. Compare that to a private foundation. When you make a gift of cash to a private foundation, you're limited to 30% of AGI for cash and 20% for appreciated assets. That's a significant difference, in my opinion. What about the tax and the investment income earned inside these two different accounts? Well, the donor advised fund, there is no taxation on the investments because it's held by a public charity, which is a tax-exempt entity. Real simple. With a private foundation, you can have a 1 or 2% tax on the net investment income inside your private foundation. To me, that's another detraction with a private foundation. In either case, you have the ability to name successors. That is, with a donor advised fund, you can name a successor advisor. In my case, I've got my wife and I are the advisors of our donor advised fund, and 2 out of our 3 kids are the successor advisors. What about the third one? Well, the third one doesn't agree with my certain world beliefs, and so I'm not going to give her rights over granting. Sorry, it's the way it is. I could do that. With a private foundation, you also have the ability to name successors to keep it going. However, what I found with these private foundations, when it hits the second or for sure the third generation, they didn't set it up. It wasn't their idea. It was either dad's or grandpa's idea to set it up. It's just a headache. We don't want to meet. We don't want to have these meetings. We don't want to do all these filings. How do we shut this thing down is more often what I hear from future generations on private foundations. With the donor advised fund, the next generation, it's real easy. Someone else is doing all the administration for them. Now they have a charitable checkbook that they can just make grants out of for the money that mom and dad or grandma and grandpa put into there for them, got the tax benefits. And so now the heirs have just granting power, and they could grant it all out the year after mom and dad die if they want. Depends on how you set up your granting parameters within your DAF. So, the question is, when do you consider one versus the other? Well, if a donor advised fund, if you want a turnkey giving solution with low cost and potential to grow tax-free over time inside the fund. So you can create a larger pool of giving if you're going to front load this donor advised fund, maybe in the last 5 years that you're working, making the big bucks, and when you retire, you're going to be on Social Security, a little pension, a fixed income, and you still want to do charitable giving. It's a nice, we call it building a charitable war chest. with a private foundation, you would do that, set one of those up when you want to operate your own charitable organization, employ staff, hire investment managers, actively manage grant making, and sponsor charitable events. Sounds like you have too much time in your hands as far as I'm concerned, but that would be a reason to set up a private foundation, because you do not have control over donor advice fund. You have recommending power, but that's it. And then this deal about supporting charities anonymously, which I already mentioned, you have that right with the donor advice fund, which is a public foundation, but it's really private from an anonymity perspective. With a private foundation, it is actually public, and you have no anonymity. Makes no sense. So what about getting one of these started if you don't already have it started, if you're recommending this to a client? With a donor advice fund, it's just you fill out an application and you say who's going to be the advisors, who's going to be the successor advisors, and who's and what do I want upon my death as far as the disposition of this donor advice fund. You could say, the kids don't want to mess with this, just send 20% to 5 different charities of my choice and it's done. Or you could say, I do want this to perpetuate for several generations. I'm making my kids and grandkids the advisors, and I just keep on going with it. Some donor advice funds have minimums to get started. Some are still at 5,000 or 10,000. I believe the Catholic foundations have a minimum of 25,000, if I'm correct on that. And some are even starting with minimums of 50,000. And then to start up a private foundation, oh my goodness, you got to lay out some cash, because you got to have legal fees to get it going. You are actually applying for nonprofit tax exempt status with the IRS. You're creating your own charity. And right now it can take months to receive your 501c3 determination letter. And sometimes that can impinge you if you sold a major asset this year and want to get this started and get a deduction before the end of the year. You may not have time. So you can see why my bias is toward a donor advice fund for all the practical and cost reasons. To me, a donor advice fund looks, acts, and smells like a private foundation without the negatives. So I'm a visual learner, so I say let's stop giving out of our checkbook. Let's set up a donor advice fund. You see this green bucket here. You see that little umbrella on the top, the blue umbrella? You know what kind of umbrella that is? Some of you have heard this before. That's a tax sheltered umbrella. And whatever happens underneath that umbrella is exempt from the IRS getting a piece of it. So think about it as a tax sheltered investment account. And into that account, you can contribute cash, but even more likely and more beneficial would be to contribute that Microsoft stock that you bought in 1972, or that piece of land, or that piece of business interest, or it used to be crypto, but crypto's gone to heck again. So you're putting appreciated asset into the donor advice fund, where then it can be sold and reinvested in a more broad portfolio, but it's being sold under that blue tax sheltered umbrella. So we can, so it really works as a great place to get kind of what I call a double tax benefit. You're avoiding recognition of the cap gain on that asset of the cash that you're putting in the donor advice fund, plus you're getting a charitable income tax deduction for the full fair market value of that asset. And you get that as an immediate income tax deduction, even though you haven't made any grants out of that donor advice fund to any other charities. And so you're avoiding cap gain recognition if they're appreciated securities. And then again, you're disconnecting the tax benefit from the ultimate distribution of charity. You can make those distributions at your leisure. So again, I'm a visual learner, so I look at this as your big bucket, and then you have got several spigots on this bucket, and you can turn on those spigots to donate to various charities at different periods of time. And you can put as many spigots as you want on that bucket. And all you're doing is going to the donor advice fund host, the foundation, and saying, I want to make a grant of $500 to XYZ parish. I want to make a grant of $500 to ABC Young People's Organization, whatever it be, as long as they're a tax exempt entity, 501c3, it works. So then guess what? You get one receipt instead of many. This is public information. You remember Barry Griswold? He was the CEO of Principal Financial Group here in Des Moines for years. A very philanthropic guy. His rule was if somebody asked me for a donation, I give it to him. That's quite a policy. But anyway, one year, and then after he retired, he he went to work and he became the president of the Johnne Community Foundation, which hosts these donor advice funds. He did that for about 5 years and took a whopping salary of about $1 a year. That was his kind of give back to the community. Well, one year he got audited, and he had made 85 charitable donations that year to 85 institutions. Well, on the audit, they found he couldn't find 2 of his receipts. So he only got to deduct 83 of those contributions. And here he is with the Community Foundation, who hosts donor advice funds. So I said, Barry, why don't you get yourself a donor advice fund? You got him right down the hall. Oh, yeah, that'd be cool. So he did that. And the next year, he was so proud. He had 1 receipt. He did all his charitable giving through that donor advice fund. So all he did was get 1 receipt from the Community Foundation for his charitable giving, and that was it. It simplified his bookkeeping. So a lot of times we don't even think about what we don't know. Then the other aspect of this that many of you probably have already used is implementing bunching and consideration of the higher standard deductions and so on. So here's just a quick example. You have a married couple, 150,000 just a gross income. They got $3,000 in mortgage interest, $10,000 in state and local taxes, which is a new limit, of course. And they're currently giving $10,000 a year to charity, so their total is $23,000. Can they itemize? Nope, because the standard deduction this year is $25,900 for a couple. So, so you take $25,900 off their $150,000 income. Taxable income is $124,100. They're going to pay $18,535 of taxes. Now, if they set up a DAF, they still have $150,000 of income, still have $3,000 mortgage interest deductions, still have assault limitation of $10,000, but then that year they give $20,000 to their DAF. Well, you add those up, now that's $33,000 of deductible expense, and they can itemize because it exceeds the standard deduction of $25,900. That drove their taxable income that year down to $117,000, and thus their taxes were down to $16,900. All right, so what they've done is just kind of bunch they're giving, because the next year after, they have the same income, the same deductions, and they're going to give 0 to charity and not claim that because they only have $13,000 of deductions at that point. So they take the standard deduction, just like they did prior to having a DAF. And then if they wish, they can make a $10,000 grant of the 20 that they set aside last year in their DAF. And so the charity's income is static. That's going to be routine, but for the donor, they saved some tax dollars, let's say every other year in this example. So that's what we call bunching your charitable deductions, and a DAF is a perfect way to do that because you get the deduction this year for the $20,000 and don't have to make the distributions for part of it until next year if you don't want. Okay, so let me just stop there, and before we shift to, well, look at there, I'm halfway done and half our hour is gone. Sue or Michelle, are there any questions that you can feed me somehow through the mechanism here? I see there's a chat. I can look at the chat. Oh, it says here your DAF minimum is 10. I thought I read on the website it's 25,000. So it is 10. There's no questions according to Sue. I'm sure Sue will have a question. I've known Sue for a long time. She's always got good questions. All right, well, unless you have any questions on DAF, we will proceed to another instrument that I learned about in 1984. It's called I got to get out of there. Charitable gift annuity. I'm sure many of you, the professions, are familiar with charitable remainder trust, which I learned about in 1984. To date, I think I've implemented 85 of those. We're working on a new one right now for $6.5 million worth of real estate. A charitable remainder trust is a wonderful financial planning and estate planning tool to create retirement income and to reduce estate size. The charitable gift annuity is what I would call the ugly stepsister, and it's not really that ugly. But a charitable gift annuity is like a charitable remainder trust minimized. It's the mini version. It's simply a 3-page contract between a charity and a donor that guarantees them income for life in exchange for a gift of assets. So it's very similar to a CRT, but much simpler. In this case, at the donor's death, they stop receiving their income. 100% goes to the nonprofit or nonprofits that were recommended in the document that they created. Some charities will issue their own gift annuities. Others will outsource that. We'll talk to you about that in a minute. Payments to the donor from a gift annuity, just like a commercial annuity, can be either immediate or deferred to a later age, depending on your life circumstance. Either way, the donor gets an immediate charitable income tax deduction calculated very similarly to that of a charitable remainder trust. And that is, you get a deduction for the present value of the future remainder that's going to go to charity at your death if you die right on time, according to the actuarial statistics. And even if you don't, the deduction was the same when you set this up. Okay, so you don't get a dollar for a dollar deduction like you would with putting the same amount of money into a donor advised fund. With a charitable gift annuity, you're going to need a deduction for what is in the future going to go to charity, because remember, you retained a life income interest on this in the form of those annuity payments for your lifetime. But guess what? You know, charitable remainder trusts were started in 1969 by Congress. Gift annuities have been around for 160 years. How come I never heard of one until I went to a conference in Boston in 1984? I don't know. Reason I think is nonprofits don't have big marketing budgets like financial institutions do. So they're not out there saying, hey, we've got these things, but they've been around a long, long, long time. Okay. There are only two types of charitable gift annuities. I told you it was simple. You have a single life annuity, so on the life of one person, or you have a two life annuity on the lives of two people, and they get the income together during their lifetime, and at their death, the survivor continues to get the full amount that they were both getting. And at their death, in either case, whatever is left stays with the nonprofit if they issued that gift annuity, or goes to the nonprofit by an outsourced foundation that's doing that on behalf of another charity. Very simple. Well, the point is, you can't do 3 or 4 or 5 people. You can't have successor annuitants like you can with a charitable remainder trust. Charitable remainder trust is much more flexible than a gift annuity. That's what makes a gift annuity simple, but you give up flexibility. So again, aha, there you see my green bucket, and there you see my tax sheltered umbrella, and there you see my spigot. Those are my favorite. I'm not much of an artist, but that's the best I could do. Okay, so Mr. and Mrs. Donor are going to contribute either cash or appreciated assets, which can be sold, avoiding cap gain underneath the umbrella, and turn that into a life income. I call it a charitable pension plan. And at their death, whatever's left transfers, stays with the charity that issued the gift annuity. So the benefits to the donor is they receive a fixed lifetime income. And I've underlined that word fixed because you might think that's an advantage or disadvantage depending on your point of view. But once you set up the gift annuity and start receiving income, the dollar amount you receive will never change. It's based initially on a percentage based on a life expectancy table, but it will never change dollar-wise from that point on. With a charitable remainder unit trust, you can have increasing or decreasing income. With a charitable remainder annuity trust, it would be very similar to this. It would be fixed. The tax benefits, the donor receives a charitable income deduction now based on the present value of the gift based on the donor's age and the monthly changing section 7520 rate, or AFR as we call it, which I just got notice yesterday in December is going up to 5.2%. It was 4.8 this month. That all affects your deductibility and how you calculate the tax deduction. Then at the donor's death, 100% is paid to the charity. And of course, it goes outside the taxable estate. When the donor makes a contribution to this the gift annuity, it's immediately off their balance sheet. They've traded an asset for a life income, and it's not there. Even if they get sued, the asset is gone. It's not theirs. The way these rates are calculated or promulgated by the American Council on Gift Annuities is they're assuming that generally about half of the original deposit is going to be left for charity if the donor lives to their life expectancy and dies at that time. And I'll show you some examples of that. So why would someone use a gift annuity instead of a charitable remainder trust? They may not like the complexity of having a charitable remainder trust, including the cost for setting one up. Okay, you got to have someone administer it. You got to file in a tax return. All those are wonderful, and I would say, it might be for someone that has smaller assets to give than a trust requires. In my opinion, after all these years of experience, in the early days, we were setting up charitable remainder trust for 50 grand. I would not do that today. It's too costly. Okay, is the short answer. But so my rule is that up to about 500,000, you should consider a gift annuity. There may be another reason to do a charitable trust, but I would probably consider a gift annuity up to 500,000, above 500,000 a contribution. Then you might want to compare it to a charitable remainder trust because you can amortize the setup costs over a larger contribution amount. So again, think about this as the little sister of the charitable remainder trust is called a gift annuity. That'd be for a donor that wants a higher income than they're currently receiving in other fixed income investments. And I'll show you why that's the case. Essentially, when you get these annuity payments, you're dipping into some principal. So the amount of your income is going to be greater than taking income only off of a taxable investment. And you can even set up a gift annuity to provide payments, a pension plan for someone else. Your mother-in-law, I have a nice mother-in-law, she's 92. I might do that for her, especially if she runs into trouble staying in her care facility down in Phoenix, where I'm going to go tomorrow and get out of this weather. Or I could do it for my sister, a valued employee, a housekeeper. You can set up gift annuities for other people. The donor gets to take the tax deduction and choose the charity that's going to receive the benefits at the death of the annuitant, but the annuitant would receive the income. So pretty useful device. And guess what? There's no setup cost. What do you fund a gift annuity with? Well, cash works. That works for a lot of things. But you can also use appreciated securities, just like with charitable remainder trust. You can use appreciated real estate, and you can even use other assets such as commodities or even closely held stock. And in fact, quick story, I was contacted in my consulting role by a local charity last March. He had an 80-year-old donor that it was his last year of farming. Last year was the last year of farming. So now this year, he's got a bunch of corn in the bin. And if he sells it, he has no offsetting expenses to take as a tax deduction. He's not buying any more equipment. You know, farmers don't pay much in income tax while they're active. But the year after they retire, they get whacked severely. So this person had 245,000. He had a lot of bushels of corn in the bin, and it was worth about $270,000. So we put that corn into a charitable gift annuity, sold the corn the next day at the elevator, and he's now getting a nice income stream. I believe at age 80, he's getting like a 7% income stream for the rest of his life that he can't outlive. And at his death, whatever's left is going to be for the charity that helped him set this up. He was going to include that charity in his will, but this way, he's getting some nice benefit out of it. He was able to avoid recognition of having $270,000 of ordinary income, which he would have had he just sold the corn outright. Okay, so it's kind of interesting how you can use these in planning situations. So who determines the annual rate of annuity payment that the donor is going to receive? That's it's based on the age of the donor at the time of the gift, and these rates are determined by the American Council on Gift Annuities, which is a separate kind of entity subscribed to by most of the nonprofits, but it's not a nonprofit itself. It just kind of sets rates actuarially. They meet twice a year to determine what their current suggested rate is. It's not mandatory. It's a suggested maximum rate. And of course, the older you are when you start getting payments, the larger the payments are going to be because you have a shorter life expectancy, just like you would with a commercial annuity from an insurance company. Payments can normally come out to the donor quarterly, semi-annually, or annually, depending on the wishes of the donor. So here's an example. These are the current rates that just went into effect July 1st of 2022. The last change in the rates was back in July of 2020. And so if you're 75 or let's say you're 80 years old today, like my farmer from Northwest Iowa was in March, you're going to get 7% of your initial deposit. That's going to be your income for the rest of your life. So if you put in $100,000, you're going to get $7,000. What happens to rates in the future will not have any effect on your income. You're going to get $7,000 for as long as you live. But, you know, where else can you get this kind of a payment return in the markets today with some tax benefits? So it truly is a wonderful device for what I would call regular, normal folks that are not gazillionaires, but they're trying to do something good for the church, for their charitable organization, but they need to do something good for themselves too, to help undergird their own financial security for the rest of their life. right now, the oldest baby boomer is age 76. So the industry is saying the next 10 years is going to be kind of a really good time for issuing gift annuities, because older adults, the older you get, the less risk you seem to want to take. And with the uncertainty of markets and so on today, there's a lot of interest in getting some kind of a level base of guaranteed income, just like the old defined benefit pension plans that we used to have. You don't see many of those anymore. So a charitable gift annuity can provide that. So the tax benefits for the CGA is, of course, you get this partial income tax deduction upfront when you make the contribution. But then the income received out of the CGA is a little different than any other instrument, depending on how you fund it. If you fund it with cash, about 80% of your income will be tax-free return of capital until you hit your life expectancy, and then it all becomes ordinary income from that point on, okay? At the donor's death, whatever is left gets paid to the charity outside the taxable estate, just like a remainder trust. And again, we would generally project that about half of what was originally put in is probably what the charity is going to receive. If the donor dies sooner, the charity will get more. If the donor dies later, the charity will get less. Now, the thing you need to know is, what if that account gets exhausted? What if this donor lives to 115? Well, the charity is still obligated to continue making those payments, even if the amount in their account went to zero. Okay. Now the charity has to dip into their other pocket to make the payments, because it's a contract between the charity and the donor, regardless of what's left in their account. So there's some risk to the issuing charity. Advantages versus disadvantages of any financial instrument, as most of you know, there's pros and cons. Advantages of a gift annuity: you get some initial income tax deduction. You have a guaranteed fixed payment for life, like a old defined benefit pension plan without a COLA. You get partially tax-free income for a period up to your life expectancy. And at the same time, you're making a planned gift. You're leaving a lasting impact to be remembered by in your community. Disadvantages: the main one is lack of flexibility. Comparing this to charitable remainder trust, night and day as far as flexibility. You cannot change the income once you start it. The only change would be to discontinue the payments and give the remainder to the nonprofit early. That's all you can do. That is it, period. A lot more flexibility with a charitable remainder trust if you need that. So what is a charitable gift annuity not? It is not a commercial annuity issued by an insurance company. With a commercial annuity, there's no charitable deduction, obviously. And you're essentially, when you annuitize an annuity with an insurance company, you're naming the insurance company as the beneficiary if you die before your life expectancy. So here's a little case study for Mary Jones. She's a fictitious retired professional. She's 75. Her husband died a year ago, and she could use some more income, couldn't we all? But she wants to leave a legacy gift to her favorite nonprofit, but she's a little concerned, am I going to have enough? Am I going to have enough? Common, I've heard that for so many years. That's a common issue for older adults. So we show her what would happen if she set up a charitable gift annuity. So she takes $50,000 in cash that she got from a life insurance policy that her husband forgot about. So she says, what can I do with this? I got to do something with it. So she puts it into a gift annuity at a nonprofit. At her age 75, under current tax rules and so on, that $50,000 of contribution will provide her with a tax deduction this year of $24,739. That's the present value of the future remainder of $50,000 going into a gift annuity. And so then what's in it for Mary? Well, if she's 75, the current rate is 6%. So 6% of 50,000 is $3,000 a year is what she's going to get in income, of which 2,037 is tax-free until she hits life expectancy, which is 17 more years. So it's a 6% annuity. The tax effective payout rate is 8%. That means Mary would have to earn 8% in a taxable investment to achieve the same net spendable income that she's going to get at 6% out of her charitable gift annuity. At the same time, she's making a planned gift to the organization that she cares about, and about half should be left at her demise to help the charity fund their future efforts. So I've shown this so many times that it's just incredible, and it's easy to understand. It's like your own private little pension plan with some pretty nice tax benefits. What else could Mary have done with that $50,000 in cash? Well, she could put it in a 1% savings account, got $500 a year, which is taxable, and had $390 to spend on anything she wanted. Or she could find a 2%, maybe today even a 3% certificate of deposit, get $1,000 a year, of which she gets to spend $780. Or she puts it in a charitable gift annuity, gets a $3,000 a year payout, of which $2,000 is tax-free. Taxable portion is $963. Her net after-tax spendable income in her 22% bracket, $2,788. Mary thinks you're a hero. Okay. And the first year she gets a charitable tax deduction of $24,739, which could help her with her bunching. So let's see what that would do. So here's the bunching calculation again for Mary. If she doesn't do the CGA, she has $60,000 of adjusted gross income. Her standard deduction is $12,950. She has current giving that she gives to charity of about $5,000. She's quite charitable. Her taxable income is $47,050. Tax paid $56,90. But if she does a $50,000 gift annuity this year, she'll get to deduct $24,739. She'll get to deduct that. Plus, she'll get to now deduct the $5,000 that she's giving outright in addition. So her total taxable income is down to $30,261. Her tax paid this year is $3,405. I've had widows in my church come to me and say, "Can I have one of those things?" "Yeah, we'll figure out how we can do that." They think you're a miracle worker because it really helps the older adult that's concerned about their own financial security that also wants to make a lasting gift at their passing. It's two for the price of one. So the question is, how do you implement these charitable gift annuities? Insurance companies don't sell them. You can't go to the bank and buy one. You have to go to a charity. And there's 1.5 million nonprofits in this country, and only 4,000 issue charitable gift annuities. There's a reason for that. There's a complexity in the administration of these things, and you have to have certain reserves set aside to satisfy the various state requirements. And then you've got ongoing admin that you have to maintain and so on. And so a lot of charities don't offer charitable gift annuities. But I've found a way to do that. In fact, we're helping the two Catholic foundations in Iowa do gift annuities by outsourcing that to another public charity. So we have a national gift annuity solutions program that's free to any U.S. nonprofit. They don't have to pay for it. It's a turnkey program that can be ready to go. I can spend an hour with a nonprofit, and an hour and a minute later, they can issue their first gift annuity to a donor. It's by outsourcing. We're dedicated to serving nonprofits of all sizes. In fact, I'm doing some work right now with Tulane down in Louisiana. There are certain states that they don't want to be registered in to do charitable gift annuities because they don't have that many alums there, and it's a big hassle to get registered in New York and California and New Jersey and Maryland. So we're helping them outsource gift annuities for just their donors in those states. Other smaller charities say, "We don't want any part of this. We don't want to do any on our own, regardless of what state the donor is. Can you just do them all for us?" And the answer is yes. So I've partnered with an organization out of Florida, which I'll tell you about, that allows us to outsource gift annuities for any charity of any size, but it's all done on a turnkey basis. There's no admin done at the charity itself. And then the rates are all based on American Council of Gift Annuity standards. It's very, very safe and secure. And the name of the firm is the National Gift Annuity Foundation, NGAF for short. It's been around for about 10 years. So again, the donor puts their assets into a gift annuity hosted by a National Gift Annuity Foundation. The National Gift Annuity Foundation provides them with a fixed income for life, tells them how much their deduction is, issues a 1099 every year to them as they have to report in their income tax, does all the administration, and then at the death of the donor, just like in a donor advice fund, can name the remainder interest to go to their public charity. So this National Gift Annuity Foundation is like a pass-through. It's kind of like a donor advice fund that issues gift annuities, if you will, in euphemistic terms. And guess what? You can actually name a donor advice fund as the remainder charity because it's a public charity hosted by a public institution. Okay? So that's how these can be outsourced, and that's what your Southwest Iowa and Dubuque foundations are using now for gift annuities. And so the minimum amount for setting up a new gift annuity for a donor is $20,000 deposit. And minimum age to start receiving annuity payments is age 55. And most people are in their 70s and 80s when they set these up. There's no contract by the referring charity. They put us in as a line item in their budget. And the gift agreement is with the donor and National Gift Annuity Foundation, and the nonprofit, it could be their own donor advice fund, is named as the beneficiary, just like they would name a nonprofit as beneficiary of a life insurance policy or an IRA. Same thing. So there's no chain of title. There's no liability coming back to the beneficial charity. All they do is sit around and take the donor for dinner once a year to enhance their relationship. And when the donor dies, they have to cash the check coming out of National Gift Annuity Foundation, who then sends 100% of the remaining value out to the charity that was named in the contract. So the nonprofit remains the relationship with the donor. National Gift Annuity Foundation doesn't jump in and start messing with your client. They just simply send money and send 1099s. That's all they do. And so there's no cost to the donor or to the nonprofit. There's fees taken out of the account itself to satisfy the administrative needs of the National Gift Annuity Foundation. So it's really clean, turnkey operation. And it's probably not too critical for the Catholic foundations in Iowa, but if you have a client or donor that's now moved to Florida or moved to Arizona, and they want to do a gift annuity to benefit either the Catholic foundations that we're hosting by today, they can do that even if they live in another state. Each state has certain requirements as to the registration. Some don't require any registration. Some, like New York and California, are egregious in what they require for a charity to be able to issue gift annuities there. It's administered by the insurance department, usually in those particular states. And so the National Gift Annuity Foundation is registered in all 50 states. So if you have a client who lives in Hawaii, they can do a charitable gift annuity and name Catholic foundations in Iowa as the charitable remainder beneficiary. I'm giving you this little piece here. The American Council on Gift Annuities has a wonderful website that can teach you everything you never want to know about gift annuities. And it talks about, how they set the rates, state regulations, and that type of thing. It's primarily aimed at trying to get charities to join. You pay annual dues. As a consultant, I pay annual dues just to be in their mailing list and to have access to all their information. But www.acga-web.org is their site. acga-web.org is American Council on Gift Annuities. And then I've got my Charitable Gift Resource Center has its own website, and you can get to that through magnifyyouриmpact.com, which is our byline, or you can actually type in charitablegivingresourcecenter.com, not .org. And on the front page, there's a little green button that says Life Income Calculator. You can punch that button and you can get to this screen here, which is actually run by the Stelter Company here in Des Moines, which is a lot of plan gifting, marketing information, and so on. And you can actually plot out what a gift annuity would look like, even a charitable remainder trust. It's all free. And if you just want a quick snapshot of, if I'm 72 and I put $75,000 into a gift annuity, how much will I receive as income for the rest of my life? What part of it, what's the deductible part? And how much do I get back to income tax free? It gives you just basic information. And so you can play with that if you're trying to model that out for a particular client. It's free. Go to my website, magnifyyourimpact.com. Side note, do you know where that came from? Sue, do you know where that came from? I can't hear you, Sue. Oh.
I'm here.
Yeah, Sue created that byline. She used to be part of Charitable Giving Resource Center until she grew up and got a real job. So that was her. So our role is to help magnify the impact of charitable gifts to nonprofits, particularly in the plan gift and estate planning sector. So that's my story. I'm sticking to it. Thank you for your attention. We've got 5 minutes left for any questions come in, Sue.
We've got one question. And Larry, I would like to know, can you fund a CGA?
I can't hear you audibly. Let's see. Can you briefly address testamentary CGAs? I forgot that. Thank you. Oh, and that says you also do gift calculators on your website. Well, they got plenty of gift calculators. Okay. A testamentary CGA. What is that? Well, testamentary means what? Goes into effect at your death. So you remember the recent Secure Act of 2019, which basically did away with the stretch IRA provisions, where an heir inheriting an IRA could take RMDs based on their age now for the rest of their life and spread that tax liability out over their lifetime. Now that's confined to a 10-year period. You got to take it out within 10 years, or you get the 50% penalty. Well, we've created what's called a charitable stretch IRA, where the donor can set up now a testamentary charitable gift annuity for their heirs. I'm doing one right now for a doctor down in Houston, and he's got $3 million in IRA assets, typical doctor. And he's got a stepson that he wants to make sure he's protected. He's 53 years old, and he wants to help him spread that tax liability out. And he doesn't want anyone to take it away from him, because he's the stepson's maybe not real good with money. So we're setting up a testamentary gift annuity, which names the stepson as the annuitant. Dr. Dad is the donor, but of course he passes away, and the beneficiary of his IRA is this testamentary charitable gift annuity. That's the beneficiary. And so the custodian, he's got 5 IRAs at 5 different custodians. We named the gift annuity, National Gift Annuity Foundation, as the charitable, as the beneficiary of his IRA. At Dad's death, it goes into this gift annuity for son, who then can start receiving income when he hits 55, if Dad dies soon, and he'll get that same amount for the rest of his life. And each one of those pieces of income will be taxable as ordinary income, because it was an IRA, income expected to receive, an asset that funded that. But it really is solving a planning problem for this person, that he could have used a charitable remainder trust, but he said, it's going to cost me $3,000 to $5,000 to have a Houston attorney set up this charitable remainder trust that's going to go into effect at my death. And then when it goes into effect, then my son has to find an administrator for it, file tax returns and all that. I just want to keep it simple. So can we set up a charitable gift annuity that goes into effect at my death? And there's no cost to do that, because that agreement could sit on the shelf for 10 or 15 or 20 years until Dad dies. Then it kicks in. There's no cost to set it up now. No cost to maintain it at Dad's death. Does that help? Michelle, is that what you're looking for? Yeah, good. Other questions?
John, I just wanted to briefly say, I know you can't hear me, but you talked about why people don't know about CGAs, and really to no fault of their own. Many professional advisors. Another common
question. Comes in all the time. Can you fund lifetime CGAs with an IRA? Not yet. But there's legislation pending. It's been pending for a while. That's going to open that door. It's called I think it's called the Legacy Act of 2022. If the Congress would pass that, if they get their act together, you could actually, their proposal is that you could fund a lifetime gift annuity with IRA assets up to $50,000, which is no big deal. But that opens the door, and often what will happen is then in future legislations, they might increase it. That's a big deal if that gets passed, because we get that question all the time. A lot of people are sitting on IRA assets, and that's their biggest chunk of asset, and they don't need all the income. They'd like to get some of that out of there and make a charitable gift out of it today. And in that case, so the answer is no, not yet, but it may happen soon if we can get some legislation passed, at least at a $50,000 level. Okay. Any other questions?
John, hopefully you can see me talking, but one of the questions, or one of the comments you brought up was about nobody knowing about CGAs, and really to no fault of their own. Many financial advisors may not know about them, but they may not use them because there's no lasting income for them for that. So John is a fee-only financial advisor, and there are many of those across the country, have known about them and have used them. But if it's something your financial advisor has not brought up, ask about it. And I know that many of our friends who are advisors say, sometimes we just don't know if that's the right fit or not. So bring it up and ask that question. As John said, we do have the calculators on both of our websites, both the Dubuque website and ours, if you want to go out and look. And both of our offices are considered the planned giving offices for our diocese. And we'd be more than happy to help you with any questions, and get lots of calls throughout the year concerning year-end gifts, estate planning gifts, etc. But any other questions that any of you have for John today? Well, for those of you as individuals, and those of you who maybe have clients that might be interested in planning a legacy that aligns with Catholic values, give Michelle or I a call. We have lots of ways to connect your faith with those values, and we'd be happy to help you with any questions or additional information that you'd like. We will have this webinar recording on our websites. Hopefully get that in there by the end of this week. And we look forward to hearing from you. And thank you all for joining us today, and have a very happy Thanksgiving. Take care, everybody.